Bienvenidos a esta nueva edición de Trading, Risk and Beyond. En esta ocasión contamos con la visita del profesor Rohan Rao de Georgia Tech University. El profesor Rao, quien ha estado desarrollando modelos para los mercados financieros en los últimos años, conversará con nosotros sobre la creciente crisis de confianza en los modelos, sobre el equilibrio entre estrategia e intuición, sobre la fijación de precios, a quién corresponde, a los traders o al algorithmic trading. Acompáñeme para discutir estos interesantes temas con un profesor a la vanguardia del desarrollo de las soluciones financieras del presente. After the crisis, this has come under attack,
yes.
The use of models.
Yes. Yes.
And you have seen many of our roundtables where experts agree and disagree on models. Everybody uses them, we need to use them, but it's not, they are not reality, they are an approximation to reality. Sure. Where do you think we stand on the belief on models? Do we still have faith in models?
Well, I think all of it rests on some sort of faith. I think all models in that sense. So what you just mentioned is, I think I remember something that happened when the Black-Scholes formula actually came out. So before that, the option prices were all over the place, and they used to still trade option prices. But as soon as the Black-Scholes formula was introduced, then you could see that the option prices in the market started converging towards the Black-Scholes price. Now, you can always question whether, was the market inefficient at that point of time, and that is why the option prices were so far away, or are the people who are trading options using the Black-Scholes model so frequently that to get a ballpark figure of what prices in the option market should you bid for and ask for, and if you're using Black-Scholes, then your prices are going to be closer to Black-Scholes. So markets and models definitely have an effect on the prices that we see in the market. There's no doubt about that. But I still believe that models should not be put to blame. And I understand from the regulator's perspective, because again, the banks have an incentive to become more complex in everything, because the banks are trying to resist any sort of regulation oversight. The banks want to get monitored less by the regulators. So they always like opacity, they always like complexity. If they have opacity and complexity, it is harder for the regulator to regulate them. If there is a model that is too far complex for them to follow, then it is really hard for them to wrap their head around and understand the risks inherent in that model. But banks don't do it because they just want to get regulated less. And again, the same model as it comes in, they make money from that, they keep everything. If they lose because of the inherent risks, then the government will come and bail them out. So I understand from the regulator's perspective why they don't like these complex models. But I still believe if market discipline, which is very important, if market discipline works, if there is a bank that is using really bad models to price its, for example, mortgages, and if the market really finds this out and if it can discipline the mortgages sold by these banks in the secondary market, when they have mortgage-backed securities in the fixed income market, because we talked about that. If they have bad models for these, right? And if the market understands this and it, discounts these at a higher rate, understanding all the risks in it, then these firms automatically will start moving away from these models and start making the models better or safer, right? So I think models are not to blame. Models are just financial, they're just tools, right? It's how you use them. I think Warren Buffett once said that derivatives are weapons of mass destruction. Well, I mean, it can go both ways. You can either use it for good, or you can use it for bad. It depends on what you want to do with it, but it is a tool.
So who rules the trading desks? Models or some trader or risk manager intuition?
Yeah, that's again, I think it's an interesting question. So I would say it's the trader who rules the trading desk. Models are just a tool for them to see what trades they can make and what they cannot make. There are a lot of people who have a very strong intuition, a lot of the traders who have a lot of experience have a very strong intuition of how the market should move or what the market should be like. And it's not that they are reliant only on one model. They use all the models that they have at their disposal, because we know that there are n number of models to price options, let us say. They'll use all of them. And they, lo and behold, they'll pick the model that always confirms their worldview. So essentially, the trader is the one who chooses which model to use to price price an option or price an asset. And so essentially I would say that the trader is in the driving seat in these cases. Even though he has many models at his disposal, he chooses the one he wants to use that confirms his worldview.
So following up on this, those prices and quotes that we see in the market are fixed there by the traders or by the algorithms?
No, that is the question that needs a lot of research, and that is where it's not very conclusive as to whether the algorithmic trades are making these prices more efficient, or are they moving them away from the fundamental prices. And that is still, I think it's an open question. It's an open question, because if someone proves saying that these algorithmic and high frequency trades actually make the market very, very efficient, then people would want to have these algorithmic and high frequency traders. And by the way, there are very few high frequency traders, and there are very cool ways of trying to spot high frequency traders. So I know this researcher, I think in Michigan, who was using genetic algorithms to look at the footprint of traders. And I think he had this, this statistic that I think there are about if I'm not wrong, 12 to 14 high frequency traders in the US who are trading in these markets, and you can see that you can see their footprints. And that is a very interesting breakthrough, because once you can identify whether a trade is from an algorithm or whether a trade is by a normal human being or a trader, right, then you can analyze the cost and benefit of these things, and then you can actually answer that question, I think, more clearly. Whether algorithms are actually doing good for the markets, or are they actually bad?
So we could say that the jury is still out on that one.
The jury is still out on that one.
Okay. One or two more questions to finally wrap it up. Model risk. One of the newest trends, or one of the new ways of thinking about models. What can you tell us about model risk, especially for our audience in Latin America that is not very familiar with these research questions?
So by model risk, I mean, do you say the risks that are sometimes not very apparent in a model, but later on you sort of find out? So, for example, the Gaussian copulas that you had, where you consider all of them to be independent, but essentially, you cannot treat them as independent. Exactly. And although you've been pricing everything using that model, and you realize later that ex post, you realize later that all those models that you've been using, there's an underlying assumption in those models which you did not really factor in. And this is a real risk for any kind of new invention that comes in. We see, like, for example, the Gaussian copula models, okay, that were used in, let's say, in valuing some of the fixed income securities, MBS tranches, etc., or even the models that the banks used, which they had these systems called the automatic underwriters, AU. So these were other kind of algorithms that ran at the background, did the credit check of a person who was applying for a loan. They did a credit check in about 12 seconds, and they could tell you whether you would get a loan or not, right? So these were all model-based. Initially, I had to go to a bank, and they would take about a couple of months to evaluate my credit. They had a few parameters on which they would make these choices. But now you had these new models that show what is the relationship between default and other characteristics of the borrower. And based on that, they would come up with whether they should give out these loans or not. There was an explosion of these new models in the market. And then later on, ex post, when we see, it turns out that many of these loans that are given out using low documentation, because they did not require any of these things, because the model said that you don't require these things, these are the loans that had the highest default rates. So model risk, I think, is extremely important when you're coming up with innovations. And the finance industry is always innovating, and I think we should always put on our skeptic's hat and judge these models, any of these new inventions and new models with a lot of care. And one needs to know the inherent underlying assumptions before you go and apply it in the real world and see how they perform.
If financial markets are always innovating, can you tell us, in your point of view, especially since you are an academic, what set of skills and knowledge do you recommend for those who want to venture into algo and high-frequency trading? What type of set of skills?
Right. So I think programming is an essential skill that everyone should know. And programming in one of the native languages. So native languages like, the lower level languages like C, C++, right? So these are the languages which are still used very heavily in the algorithmic trading world, because these are much, much faster when you run these algos. And there are ways to optimize these things, and you have a lot more control. So if there is someone who wants to venture into this career path, I would seriously recommend them to start with programming, and again with C, C++. And they should also have a good working knowledge of finance, and understand the fundamentals, how the markets work. And I think that will help them, make good models and good strategies, and also be, responsible to a certain extent. But I would say programming is far more important than anything else in these cases. Because
okay, to finally wrap it up, what is your opinion so far of the Risk Management and Trading Conference? I think this is the third time or the fourth time that you attend.
Yeah,
you have been here since the beginning. I remember interviewing you back in 2012. Back in the other venue.
Right.
So you are a veteran of these events. What is your opinion about the quality, the people, and their contribution to the training and professionalization of finance people in Latin America?
Oh, it's great. I mean, every year I come in, I'm even impressed more. Firstly at the scale at which these things are organized, and how well they're organized. And the people who come here, as participants, they're really very smart. They have a very good working knowledge of finance, and they have the right background, I would say, and which is very important, to assimilate, and as much as possible when you have such world-class, lecturers coming here and presenting. It's always a pleasure to be here, and I've seen people every year. The quality of people has only become better, so it's always wonderful. And today I think we had chance to see the trading floor that I think RiskMathics invested and put together. It is really exceptional in what was built out there, and very, very impressive. And it's a huge step for, I think, all the Latin American countries and the entire finance scene here, because you guys have taken it upon yourselves to educate everyone financially. And I think it is very important for any country to prosper. You need to have financially literate people. And I think you guys are doing the right thing, and you're in the right step moving forward.
Thank you very much.
Thank you, my pleasure.
Gracias por acompañarnos en esta, la más reciente edición de Trading, Risk and Beyond. Soy Gerardo Herrera, su anfitrión. Gracias por acompañarnos. Lo esperamos en las siguientes ediciones. Soy Gerardo Herrera, su anfitrión.